Hello and welcome to Investment Insight Network. Before we touch on today's subject of recession, please find the time to read the disclaimer. Thanks. Today we're talking about a very important topic that's been in the news a lot lately. The collapse of Silicon Valley Bank, Credit Suisse, and the latest being First Republic at the time of publishing this video. This has raised concerns about the health of the financial systems in Europe and America. And many people are wondering if a financial crisis is on the horizon. So is a financial crisis really coming, or is it already here? Let's find out. First, let's talk about the basic laws of financial crisis. A financial crisis usually happens when there's a scarcity of liquidity, which can lead to problems with banks, credit, currency, and most commodities. For example, the financial crisis in 2008 happened because of the housing bubble and debt defaults, which were caused by low interest rates that encouraged people to buy houses on mortgage loans. Later, when the central bank raised interest rates, it increased the pressure and cost of buying a house. When people couldn't repay their mortgage loans, it caused a chain reaction that led to a financial crisis. But this time, the crisis didn't spread and cause a chain reaction like in 2008. So we shouldn't jump to conclusions. Instead, we should reflect on what we should do if a financial crisis does happen. If a financial crisis happens, what should ordinary people like you and me do? The answer is simple. We must have cash on hand. Having cash can help us avoid a break in cash flow. And for the benefit of those viewers who are not familiar with what liquid assets are, they are assets that allow you to turn them into cash in a very short time. Examples are precious metals like gold or platinum, fixed deposits, FCFD, foreign currency fixed deposits, if you are required to have a certain amount of cash flow in that foreign country. There are also stocks, bonds, and ETFs, just to name a few. We will dive deeper into how and why we would choose which asset groups in a different episode, based on what we're facing in the coming months, and how these assets may help us hedge or provide a window of opportunity. So let us get back to the topic of a financial crisis. During a financial crisis, banks tend to tighten credit, making it difficult to borrow money. If you're an entrepreneur and can't borrow money from the bank, your funding chain is likely to break. Also, if you have cash during a financial crisis caused by asset price crashes, you can take advantage of it and go beyond others. When market liquidity increases with time and the recovery of social investment, asset prices will rise sharply. During these price crashes, investors can get very generous returns. One way governments stimulate the economy during a financial crisis is through a loose monetary policy, where the central bank or other monetary authority takes actions to increase the money supply and make credit more readily available. By reducing interest rates, purchasing government securities on the open market, or lowering reserve requirements for banks, businesses and individuals can borrow and spend money more easily. This policy is often used during times of recession or when the economy is struggling to grow. So what can we learn from previous financial crises? One of the key takeaways is the importance of diversification. By spreading your investments across different asset classes, you can reduce the risk of losing all of your money in one market. For example, instead of putting all your money into stocks, you can also invest in bonds, real estate, and other types of assets. Another important lesson is to avoid panic selling. During a financial crisis, it's easy to get caught up in the fear and uncertainty of the market. However, selling your investments during a downturn can often do more harm than good. It's important to stay calm and think long-term, especially if you have a well-diversified portfolio that includes different types of assets. Finally, during a financial crisis, governments can play a critical role in stabilizing the economy and preventing a deeper recession. By introducing loose monetary and fiscal policies, central banks can provide liquidity to the market and encourage borrowing and spending. Governments can also provide support to struggling businesses and households, such as through direct cash payments or loan guarantees. In conclusion, while it's impossible to predict when the next financial crisis will occur, it's important to be prepared and have a plan in place. By diversifying your investments, staying calm during market downturns, and keeping an eye on government policy, you can minimize the impact of a crisis on your personal finances. Remember, every crisis usually also presents new opportunities. I hope I have painted a clearer picture of what a recession may look like, and made you aware of when or if a recession has reared its ugly head around you. I think I will stop here for now and thank you for watching my latest video. I do want to remind you to tune in to my upcoming videos where I will be looking at the possible moves by the Federal Reserves for the rest of 2023 and beyond. I'll also be discussing how I may adjust my assets accordingly. I hope you found value in this video, and I'm excited to share more insights with you soon. Have a wonderful week ahead.